Good afternoon, ladies and gentlemen, esteemed clients and panelists. You're all welcome to our webinar titled Capital Gains Tax, What You Need to Know. This webinar is organized by CSL Stockbrokers, a wholly owned subsidiary of the FCMB Group. My name is Foluke Samuel, and I'll be the host for today's webinar. Capital gains tax has been a subject that has been on the minds of every one of us, Nigerians, and even for investors. There have been questions, concerns as to how the capital gains tax would affect our investments in the coming year. This is why CSL Stockbrokers have put together this webinar to answer the many questions in the minds of a lot of us present here today. And we hope that at the end of this seminar, at the end of this webinar, we would have all the answers to all of our questions. We'll be taking the welcome notes. This will be taken by Mrs. Ifoma Ukuna, who is the head retail business CSL Stockbrokers. Ifoma, good afternoon and welcome.
Hello, Foluke. Good afternoon, everyone. On behalf of our Managing Director, Mr. Layo Laleru, I welcome you to today's webinar titled Capital Gains Tax and its Impact on the Nigerian Investor. Thank you for joining. I know you all have a lot to do, but thank you for sparing time for this webinar. And thanks for joining us as we explore how CGT will evolve come 2026 and what it means for your investments. We convened this webinar because we've had customers ask questions about how the new tax law will affect various investments, which investments in particular will be affected by the changes in the tax laws, and what exemptions or special provisions may apply to investors. So our goal today is to provide clarity, insights, and even give you some guidance on how to plan your investments with confidence come 2026. We have assembled a team of seasoned analysts and tax professionals who have profound experience in Nigerian tax law and the capital market as a whole. And they will provide deeper color and practical examples of how CGT will affect your investments. I am pleased to announce that Mr. Oni James of Tax Professionals is here with us today, and he will also be available for follow-up consultations on tax matters. Please keep your questions ready for him and for other members of the panel. I assure you that you will leave here today with enough information about CGT and its impact on your portfolio come 2026. Thank you once again for joining us.
Thank you very much. Thank you very much, Ifoma, for that wonderful welcome notes. I'll be going on with reading the profiles of our esteemed panelists. As mentioned by Ifoma, we have on the panel today Mr. James Oni. Mr. James Oni is a tax professional with over 15 years hands-on experience guiding organizations through Nigeria's dynamic tax and regulatory landscape. He currently serves as the Director and Head of Taxation and Regulatory Advisory at Tax Advisory Services, a member of the Tax Group. Mr. James has provided strategic tax leadership to clients across oil and gas, FMCG, and financial services, as well as several multinational corporations, helping them to navigate complex compliance issues and develop efficient tax structures that drive their business growth. He holds a bachelor's degree in accounting from Olabisi Onabanjo University, a fellow of the Institute of Chartered Accountants of Nigeria, and an associate member of both the Chartered Institute of Taxation of Nigeria and the Association of Accounting Technicians West Africa. He is known for his practical insights and results-driven approach. He has successfully resolved major tax disputes, led advisory engagements with regulatory bodies, and facilitated impactful trainings and tax discussions on tax strategies, compliance, and reforms. Welcome, Mr. James, and thank you for joining us today. Also on the panel is Mrs. Gloria Fadipe. Mrs. Gloria Fadipe is a seasoned investment and research professional with over 15 years of experience delivering strategic insights to both institutional and retail investors. She currently serves as the head of research at CSL Stockbrokers, where she leads a team of analysts in producing high-impact macroeconomic and equity research that guides investment decisions across domestic frontier and emerging markets. Gloria holds a first-class degree in zoology from the University of Ibadan, an MBA from Pan-African University, Lagos Business School, and a master's in economic development distinction from the University of Glasgow. Her career began in Zenith Bank, where she worked in banking operations before proceeding for her MBA at the Lagos Business School. She joined Diamond Capital and Financial Markets, a subsidiary of Diamond Bank PLC, as a research analyst, covering listed equities and producing market reports. In 2012, Gloria joined CSL Stockbrokers as a senior equity research analyst focused on the banking sector. And in 2016, she became the head of research for CSL Stockbrokers. She is known for her analytical depth, strong communication skills, and passion for investor education. Gloria brings a wealth of market knowledge and a practical, insightful perspective to investment conversations. Mr. Omobola Adu serves as the lead economist at CSL Stockbrokers with over 6 years of experience analyzing the Nigerian and broader sub-Saharan African markets. Prior to joining CSL, he worked as an SSA economist at Bank Trust & Co., where he provided primary coverage of Angola, Ghana, Kenya, and Nigeria, alongside secondary coverage of markets such as Egypt, Ivory Coast, Senegal, and Zambia. His in-depth thematic research has offered critical insights into SSA economic trends, supporting compelling investment narratives for both local and international investors. Omobola's expertise has featured on prominent platforms such as Bloomberg, Arise News, Channels Television, African Report, and Business Day. He holds a PhD in economics from Covenant University. Thank you very much to every one of our panelists, and we hope that this session will be engaging and you bring your wealth of knowledge and expertise into the conversations today. We'll be taking our keynote speech this will be taken by Mr. James Oni, who is the guest speaker for today. Thank you very much, Mr. James, for joining us today.
Okay, thank you for looking for having me. Can you hear me?
Yes, we can.
Okay. All right, thank you so much for the brief introduction. So I would first of all like to appreciate the management of CSL Stockbrokers Limited for giving me the opportunity to present this session, and I do not take it for granted. So let us just dive straight to what we would like to discuss today. And today I'll be talking about capital gain tax on investors based on the Nigerian tax reforms. But specifically, I'll be talking about all the issues or speculations surrounding the capital gains tax. because there are many investors today that they really do not know how this capital gains tax actually works. So we'll just be doing a brief review on capital gains tax and how it affects investors. And I'll be using the next 10 minutes to do justice to these. And I know that we also have a panel session that will also take a look, an in-depth review of what we'll be discussing today. So what is the rationale? Okay, let me put it in presentation mode so that we can see clearer. Okay, so there are some misconceptions around capital gains tax, and that is what I would like to address today. And that also means that let's understand the fact that there is no more capital gains tax on unrealized gains, because there are some gains that investors make which are realized. So that is what is going to be subjected to capital gains tax. But going forward, when you talk about unrealized exchange gain, unrealized gains on disposal of shares or stocks, then that would no longer be applicable to capital gains tax. So I know that some of us might be aware of these major exemptions. The major exemptions basically has to do with share of disposals, and when you make proceeds that is less than 150 million, and the gains is not more than 10 million, then such will be exempted from capital gains tax. And if you dispose of that shares within 12 months in a consecutive month, then that will also be exempted from capital gains tax. Another exemptions in the Nigerian Tax Act that relates to capital gains tax is what we call the investment of the shares that is disposed, right? So if you dispose of shares in Nigerian company and you dispose it off and you reinvest that shares in another Nigerian company within the 12 consecutive months, then that would also be exempted from capital gains tax. But let's also note that this does not have any threshold. So the first one that I mentioned earlier actually has a threshold of 150 million proceeds and and a gain of 10 million. But this does not have any threshold. So if you're even dealing with billions of shares or maybe transfer of shares from one entity to another entity, provided that shares is being transferred from one Nigerian company to another Nigerian company, then that means that it is totally exempted from capital gains tax. Another one is where you deal in shares in a regulated security platform, right? So in a regulated security lending transaction was defined by the Nigerian Tax Act as shares that you deal in the stock market, right? Nigerian Stock Exchange, that is, by Security Exchange Commission. That is how it defines the regulated security lending transaction. So if you transfer shares from an approved lender to an approved borrower, so an approved lender and approved borrower simply means that you are being given license, okay, to trade in shares. So if you transfer shares from an approved lender to an approved borrower, then that means that it's going to be exempted. There are other exemptions as well, which we need to look into, which is what I mentioned about, the foreign gains. For instance, if you dispose of shares outside Nigeria, right, maybe a non-resident disposes of shares outside Nigeria, provided that that's the gains that you make on the disposal of the foreign shares is being passed through, is being brought in into Nigeria approved channel, right? Government approved channel is like the Central Bank of Nigeria. So if you bring those gains, okay, into Central Bank of Nigeria, then that would completely be exempted. Although there are some rules that guides the nitty-gritty behind disposal of foreign shares or the gains that you make outside Nigeria. So another area is small companies. So small companies, in accordance with the Nigerian Tax Act, is companies with a turnover of less than equal to 100 million, okay, an asset base of 250 million or less. So that is another area So if you fall into this category, then if you dispose of shares, then you are exempted from capital gains tax outrightly. And another exemption is those PFAs, those institutional investors, such as PFAs, pension fund administrators, or real estate investments, trust scheme, and some other NGOs as well. Okay, so these entities are institutional bodies that, okay, when they trade in shares, when you invest in them as well, it is completely exempted from capital gains tax. Now, I'm going to talk about the rates for companies, right? Because there are some CGT framework compared to what it used to be before. Of course, most of us here understand that CGT, capital gains tax on the disposal of, or the gains on shares is 10%, right? But now it has increased to, it is now between 0 and 30% rate. And I'm going to try to explain how this works, right? So many people are saying that, or many investors are, having the fears that, do I need to dispose of my shares from the capital market? Do I need to stop trading in shares or whatever because of the increase in the rate of 30%? Okay, so that it doesn't work that way, right? That is what I just came to clarify here. And also, in case you make capital gains loss, right? If you make capital losses rather, right, then you can actually use your capital loss to set off your capital gains that you are earning subsequently. So you are not supposed to pay taxes on your capital loss. For instance, if you dispose of shares, okay, from maybe shares that was worth 5 naira and you dispose it at 3 naira per share, then that means that the 2 naira loss that you make can actually be carried forward as a relief against subsequent gains. So, and there's also the rate for individual. The rate for individual is also not direct. Okay, it's not straight, it's not immediate, it's not direct. So when individual disposes of shares, there's what you also call the graduated rate in accordance with the Personal Income Tax Act, which we are going to look at today. So this is an example. There's what we call the cost-based reset. The cost-based reset for capital gains is usually said to be the higher of the actual purchase price or the closing price on 31st December 2005. And this is to ensure fairness and prevent tax on historical gains. So, the president of the Reforms Committee, Tayo Oyedele, actually clarified this in November this month, okay, where many people many investors, in equity investors are like, what are we going to do? What about I'm holding the shares for over 10 years and that shares has appreciated, okay, it has actually earned some form of appreciation, okay, and as at 31st December, if I dispose of that shares from next year, are you not going to subject me to CGT at 30% on the gains that I have? So many people want to dispose of their shares before 31st December. So this is how it works. There's something about the cost-based reset. So the cost-based reset simply means, this is an example. If you can see my screen, it says if value of the stocks as at 31st December 2023 was worth 5,000 and has risen since then, so that should be 5 million, and has risen to 20 million as at 31st December 2025. Assuming the shares was sold for 22 million, you have stocks of 5 million in 2023, and that stock has risen to 20 million as at December 2025. Now, you now sold the shares maybe next year, January, right, after the implementation when the Nigerian Tax Act kickstarts for 22 million. Now, what it simply says is that you are not going to look at the historical cost. That is the cost-based reset. So, and you are going to calculate the market value of that shares as at 31st December 2025, right? You are going to look at the value of that shares, and that is the value at which, that is the value that will be the cost of that shares. Then the proceeds will now be deducted from that cost. So this is the implication. The first one is the old CGT treatment, which you would have made about 17 million naira taxable gain. So that means CGT will be applied on 17 million. But applying this principle of cost-based reset means that you are earning about 2 million naira gain. Okay, that is what it means. So instead of you being taxed at 17 million, you'll be subjected to tax at 2 million. So that is what we need to understand about the cost basis, because the value of the shares as at 31st December 2025, it's very, very, very important. And another area is the CGT on corporate investors. For corporate investors, you look at these capital gains, you can see it's not as if it is applied directly 30%. So if you are if a company, right, disposes of shares, for instance, or maybe by the way of either assets or whatever, and you now earn capital gains, then that means that the capital gains will be included as part of your tax computation. So the tax effect of these capital gains is not directly 30%. In fact, it could even be as low as 20%. And it could even be that you might not even pay taxes on the gain that you are earning, okay, when you dispose of an asset. So this is how it's going to be, computation is going to be. It's going to be added because your CIT rate is 30%, right? Your company income tax rate is 30%. So the capital gains tax is not directly 30% because there are some nuances that, oh, the capital gains tax is going to be 30% flat. No, there are times when it will be lower than that. It could even come down as low as 20%, 25%. So it depends. So another area is for individual investors. For individuals, it's going to be, the law says that it's going to be based on graduated rates. And that's why I have the graduated rate here on here, between 0 and 800,000. You're not going to pay any taxes at all, and you're not going to pay any CGT. And if you look at this analysis, which I have done, maybe I can navigate my cursor for better understanding. So this is an annual income of 500,000, and this individual has made a capital gain of 5 million, right? What it means is that it's going to be exempted from CGT, and it will also be exempted from payee. Because why? On your payee, you have not earned any annual income that is up to, that is more than 800,000 naira, right? And for capital gains tax, you have not earned any gain that is more than 10 million. So automatically, it's going to be exempted. And you can see that the tax rate here is 0, right? So the second one is the 2 million, whereby an individual earns an income, maybe like salaries of 2 million, but on the other hand, maybe his other income, he earns about 8 million, right? It would also be exempted, but the 2 million will be the one that will be taxed only because it has fallen within the band of 800,000 and 3 million. So that will be subjected to 15% rate on, and you're going to apply only on PIT only, payee only, right? But the next one, which is what I highlighted in yellow, it will be subjected to tax, and both will be subjected to tax at the rate of 23%, right? So for individual investors, right, like for retail investors, most of us, some people deal with retail investors. You can see that this is the analysis. That means that it's going to be subjected to tax, CGT at the rate of 23% and not directly 30%. I hope, because of our time, I would just like to round up here. What I would just simply say is that you just need to keep your records properly, right? Ensure that you keep all your records properly, and you also need to evaluate your portfolios and the strategies that you make you to be able to maximize your returns, okay, based on this capital gains tax. And thank you. I would just like to stop here. Thank you for having me.
Thank you very much, Mr. James, for that insight and clarity. I'm sure a lot of questions have been answered, and you have, in your best way, presented us with clarity as regards to how the capital gains tax would apply to individual investors and even to corporates. I would like to state at this point that you can drop your questions on the Q&A box, which will be taken subsequently. We'll be going straight into the panel session. And here we would have our panelists answer some of the questions that we might have alongside your questions, which would come up much later in the webinar, during the webinar. So I know there are a lot of questions, and one of the questions, and I'll be directing this to Gloria Fadipe. There are a lot of questions regards to which instruments and transactions are within the scope of this capital gains tax for equities. I don't know if you can provide some clarity and answers to that question.
Okay, thank you very much, Foluke. Thank you for having me, and thank you for the question. So, what kind of transactions and instruments are within the scope for CGT? So I'll like to emphasize that CGT may apply when there's a disposal of a chargeable asset. And I'll give examples of some relevant transactions. Selling of shares or securities. I mean, everyone knows that. Selling or transferring corporate bonds, held to maturity instruments, redeemable preference shares. Generally, non-government debt instruments could also be applicable. Transferring ownership, as long as the ownership changes, that may also constitute a disposal for CGT. Disposals by non-resident persons, if the assets are deemed to be located in Nigeria under certain conditions to are applicable. But that does not mean that there still remains some ambiguity around some of these things. Some of these aspects are not fully settled. For example, the status of corporate bonds or non-government debt instruments. Some sources say gains from their sale are subject to CGT. Others note that there could be a waiver that could be approved for such gains. I think that though the waiver may not yet be legally effective, but that still needs some clarity. Also, we also need clarity on how to classify digital assets. We need to, under recent reforms, digital assets are legally classified as securities. They may also be chargeable, but that still needs some clarity as well. So I guess that answers that question.
Thank you very much. Thank you so much, Gloria, for that response. Okay, so the next question would be to Omobola. I actually have this question on the chat box. And the question is with regards to dividends. It says, how does the capital gains tax interact with taxation on dividends? How does CGT interact with taxation on dividends?
Thank you, Foluke. Just confirm, please, if you can hear me clearly.
Yes, we can.
All right, great, thank you. So, yeah, that's a good question. And it's just to mention that tax on dividends are still in place. So based on laws, the tax on dividends are around about 10%. So that means as an investor, when you get dividends from whatever companies that you've purchased on the Nigerian equity market, before those dividends are paid to you, they're already going to be taxed. So that one is aside. And then the CGT just applies to when, as an investor, you decide to sell that stock on the secondary market, right? So in that process, when you make your sales, you are supposed to pay CGT on the sales that you've made in the market. So it means that as an investor, you need to be aware of your full after-tax return. So aside tax that you might incur in terms of selling your shares on the equity market, in terms of dividends, you are also going to pay tax on dividends. So as an investor, you're more or less going to receive your dividends after tax. So that one is basically deducted directly by the registrars or the relevant bodies that are in charge of paying your taxes to you.
Thank you very much, Mobola, for that response. Okay, so the next question I'll be passing on to Mr. James. I know during your presentation, you said something around having your documents intact. Now, my question is, and I'm sure that's one of the questions in the minds of everyone here, what documentation is required to compute and report these capital gains on stock transactions?
Yes, thank you for that question. So there are some documents that are very, very germane for it to be kept, okay, by investors, right? I know that when you have stockbrokers, some of us may have shares with some stockbrokers that are trading for us, and why some of us will do ourselves, right? So, but there are some germane documents that needs to be kept by investors, especially those that trade in equity or shares. So, like for instance, is the date of acquisition of those shares, right? Those documents is very, very key for it to be kept. And you also have the date. The date is very important because from next year, January, there's every tendency that, like I mentioned, the cost-based date is very important. So the FIS will be looking at the date that you purchase or acquire that particular shares compared to 31st December 2025. So the documents that will show the date your shares was acquired is very, very key, right? And also there are some other documents that needs to be kept. For instance, your share disposal documents in case you dispose of shares. And for some of us that might have some form of investments in foreign companies, right? It's also important that you also keep those documents. So every transaction that relates to equity, okay, from your dividend to your equity to your shares, they are very, very key. Okay, you need to keep it because it's going to be one of the tools that the FIS will use for investors in this capital market or primary market or secondary market. Yeah, thank you.
Thank you very much, Mr. James, for providing that insight as regards to the documents that we need to keep, to file for this capital gains tax. So my next question would be to Mr. Mobola. And the question is, what are the rules? Are there rules about the reinvestment of proceeds and any capital gain deferral options? Are there any rules, about reinvestment of proceeds and then any CGT deferral options?
Yeah, so thank you for that question. So I think the keynote speaker talked a little bit about this previously. So I'll just reiterate some of the things that were mentioned. So based on the disclosure by the tax committee, it was mentioned that reinvestment of proceeds into shares of Nigerian companies within 12 months will qualify for full exemption, where the exemption threshold is exceeded. So basically what they're just trying to let you know is that when you sell, let's say you make a sale on the Nigerian stock market, you get your proceeds. If that proceeds is going to be reinvested, that is the gains that you've made on that stock that you just sold. If you are going to reinvest those proceeds back into the equity market within the next, let's say, 12 months, so that's basically a year, then basically you are going to be qualified for full exemption in terms of CGT. So basically it's just showing you that in terms of the tax that you would have paid when you are going to sell the stock, because you are reinvesting it back into the market, you are getting to be exempted from paying CGT on those on the proceeds from your selling of the stocks on the markets.
Thank you very much, Mobola, for that response. I would like to remind us to please drop our questions. I see some questions already that have been dropped in the question and answer box. I expect that we drop our questions, which we would answer during the question and answer session. So we'd appreciate if more questions are dropped on the Q&A box, so that the panelists can give justice to those questions. Okay, so my next question will be to Gloria Fadipe. And this question is basically on how the CGT, how does it differ, how does CGT on stock differ from other taxes on equity, such as your stamp duty, corporate tax on dividend? How does CGT on stock differ from taxes on equity?
Okay, thank you, Foluke. So yeah, CGT on shares, like I said at the start, is based on the capital gains made on selling your shares. So if you, like the tax consultant had said earlier, if you bought shares at 100 million and you're selling at 120 million, the 20 million capital appreciation is subject to CGT. Who pays for that is the seller, you who is selling. And what's the typical rate? From what we have heard, we're looking at, depending on thresholds and all of that, it could be about 10 to 30%, and it applies only when you sell the shares and dispose of the shares. Now, for stamp duty is based on documentation or share transfer. It's just a small amount. It's fixed, usually fixed, maybe about 500, 5,000 on, it's usually a small fixed amount when there is documents of or share transfer, and usually part of all the charges that are generally levied when you buy or sell shares on the exchange. Typically, the person who buys pays the stamp duty charges, which is usually very small, like I said, small and significant fee. Corporate income tax on company profits, we know that what that is. Usually that does not affect investors, not paid by investors. It's paid on based on the company profits that the company makes at the end of the year. Then dividends, like we said, dividends, CGT is not charged on income. It's charged on capital appreciation on your assets. So dividend is an income you get regularly on an asset. So what is charged on dividend income is what we call withholding tax, and currently is at 10%, and it's usually charged at source. So as long as the company has given dividend and before you're paid, the withholding tax is usually taken at source. So that is completely different from CGT. In the case of CGT, we are just looking at the capital appreciation, not the frequent or incomes that come from your owning of that asset.
Thank you very much. Thank you so much, Gloria, for that response and insight. Okay, my next question would be to Mr. James. And I know you spoke about it earlier with regards to an investor who buys and keeps for a while. So the question is, for a long-term holder, an investor who has like a long-term outlook towards an investment, with a holding period beyond a defined threshold, does the capital gain tax rate change? Does the capital gain tax, does it change for a long-term holder whose holding period is beyond a defined threshold?
All right, thank you for that question. So usually the rates for capital gains tax, like I explained earlier, okay, actually varies, unlike the way it used to be before. Formerly, before the implementation of the Nigerian Tax Act, which is going to start 1st of January 2026 next year, it used to be 10% flat, okay? And usually capital gains tax is triggered at the point of disposal. If you don't sell, there is no capital gains tax. Right. I mean, Omobola actually mentioned it earlier, right? If you don't dispose shares, if you don't dispose even assets, if you don't dispose assets, capital gains tax is not triggered, because at that point you are not earning any gain, right? You can only earn a gain when you have disposed. Now, coming back to your question, it depends on the type of the behavioral attitude of the investor. Some are risk averse, while some are risk takers. Okay, the risk takers will say, I don't care whether you like, I will just go and I will sell regardless of the capital gains tax. And while some would want to hold the shares, they will say, okay, I'm a little bit risk averse. I don't mind, I don't want to make gain, I don't want to make gain. Let me just hold on to the shares maybe for 2-3 years, and and the like. So that is what you can brief as both. But usually, if you don't dispose of shares, the capital gains tax is not triggered. But there are some. So the way it works, especially for those that works in stockbroking firm, you realize that even in a month, you can be trading in shares, okay, within a 12 consecutive months. Sometimes you make gain, sometimes you make loss. You make gain, you make loss. You know, in January, February, you make gain. So you'll be trading in shares, in different form of individual shares or corporate shares. But the issue is that at the end of the year, that will now be the determining factor. That is what they call the 12 consecutive months. So at the end of the year, you now begin to determine what the capital gains tax is going to be. Have you exceeded 150 million? Okay, or have you made a gain of 10 million for that 12 consecutive months? So that are the things you are going to consider. But overall, capital gains tax rate does not really, it doesn't change. Okay, but it depends on the behavioral attitude of the investor. Why some intends to hold the shares for a longer period, whereby the shares appreciate, okay, before they sell. Some tends to sell the shares, but generally the rate still remains the same. Yeah, thank you.
Thank you very much. Thank you so much, Mr. James, for that response. Okay, so the last question before we go into the question session, the Q&A session, would be to Mr. James. And the question is, how does Nigeria's CGT on equities, how does it compare with the capital gains regime in neighboring countries?
Okay, so I would like to thank you for the question, first of all. But I would like to say that, you know, some companies, some individuals, right, or companies, they are now looking at other neighboring countries. They want to know whether to invest in other countries, which is going to be best for them, whether to take out their shares, either sell their shares and invest it in other countries that have a lower rate. But I can tell you that there are many things that surrounds this thing, because even the foreign shares, there's something we call indirect transfer of shares, which is in Nigerian Tax Act, right? If you transfer shares, foreign shares, and it is not passed through, you don't pass it through a government approved channel, then there's every tendency that even capital gains tax will still apply. But now you now talk about maybe like bilateral treaties. There are some, Nigeria has treaty with South Africa, for instance. In fact, the treaty is called the bilateral treaty of income, profits, and capital gains. Is specifically mentioned, right? Even in the treaty with South Africa. But if you look at Ghana, Ghana basically is around 15%, right? Kenya also is around 50%. I think it's only Cameroon that I know that you have about between 50 and 15% and 30%. But of course, like I said earlier, the rate in Nigerian rate is not exactly 30%, right? Especially if you individual disposes of shares, you will still have to take out your costs, your transaction costs, your stockbroking fees. All those costs are allowable. You have to deduct those costs first before you will then know the amount of gain that you apply. Even on the gain, you still need to look at the graduated rates. So it is not exactly 30% if you look at it in detail. So I think it's just to clarify. But for other neighboring countries, it's still within the range of 15% and 30%. And for Nigeria that have bilateral treaty, okay, that means double taxation treaty with other countries, then it may probably come down a little bit below that 10% or 15% rate. Yeah, thank you.
Thank you very much, Mr. James. Thank you for that explanation. At least we have a better understanding. And it's clear to us now that it's not about selling down your investments, your portfolio, and reinvesting in neighboring countries, but to understand that the capital gains tax is prorated, just like Mr. James has said, and it's also subject to your personal income. You know, so thank you so much for providing clarity to the subject. We'll be going straight into the question and answer session. A lot of questions have been dropped. Even would still appeal to the participants. If you have your questions, please do well to drop them in the Q&A box. So I'll be reading out some of the questions that we have here already. Okay, the first question, it says, if you sell shares and make gain above 10 million, but the proceeds of sale are less than 150 million, will the gains be subject to capital gains tax? I think I would want Ifeoma to answer that question, please. Ifeoma.
Okay, thank you, Foluke. So the question is, would gains less than 10 million naira be subject to capital gains tax? Is that the question?
Okay, so it says if you sell shares and make gain above if you sell shares and make gain above 10 million, but the proceeds of sale are less than 150 million, will the gain be subject to CGT?
So the first criteria for CGT is that the sales proceeds will be over 150 million naira. So that criteria has to be met first before applying other criteria, like whether it is up to 10 million naira gain or more. So if it doesn't meet the 150 million naira threshold, regardless of the volume of profits, CGT will not apply.
Thank you very much, Ifeoma, for that response. Okay, the next question here says, are investments in treasury bills going to be taxed going forward? And what will be the procedure? Mr. Mobola, I would want you to answer that, please.
Yeah, so what is currently, or what I believe that is currently applicable is that short-term securities are subjected to withholding tax. So I believe that's what is still going to be in effect for, at least for treasury bills. From what we understand, although more clarity is still expected, at least before next year, is around the bond side. So we know that for federal government bonds still remain exempt from at least withholding tax. But in terms of the applications for CGT and those other kind of investments, we believe that more clarity would still be at least provided by the tax committee and within the next coming weeks. But I would say that for at least for short-term securities like treasury bills, withholding tax is the one that is still being effect, apart from other regulatory requirements or deductions.
Thank you very much, Mobola, for that response. Okay, so the next question I have here is, what is the tax rate on the CGT? Or will it be taken into consideration when computing CIT? If so, how do we apply it? Mr. James, being the tax consultant, would want you to respond to that, please.
Okay, so the way CGT works in accordance with the law, what the Nigerian tax says is that the rate of capital gains tax is going to be subjected to tax in accordance with the income that is being taxed on that company income tax. So what it simply means is that when you are filing your company income tax returns with the FIRS, you have to include anything that has to do with your capital gains as part of your company income tax returns. That is what it means, right? Initially, you have to file your capital gains tax returns separately, I think within 6 months of the accounting year end, or maybe at the end of 31st December for those that have accounting year end of 31st December, right? So, but now going forward, it's going to be added to your accessible profits, right? Before you then apply the application. In fact, if we make a loss the loss will also be carried forward as to claim as a relief against company income. So it's all together now with company income tax for those that, I mean, for company investors, right? For corporate investors rather. But for individual investors, then you also need to apply it in accordance with the graduated rates. But there are some that has to do with buying and selling, which is the stockbroking aspect. The one I mentioned earlier could probably just be in form of disposal of assets that would trigger capital gains. But when it comes to shares, right, which has to do with buying and selling, so the stockbroking firms going forward, they need to also tweak their rates, right, to align with the current development. So that to the extent that if you're an individual, the right amount of rate to be applied. But I think that is how it's going to work, I believe. But we expect the FRS also to issue a circular in this line, maybe before the end of this year or the commencement of the act next year. I want to believe that the circular will be issued to clarify all of this better. Thank you.
Thank you very much, Mr. James. Thank you so much. So the next question we have here says, is the capital gain tax applicable to all profits accruable from sales of shares or only to profits up to a certain amount? I would want Mrs. Gloria Fadipe to respond to that, please.
Okay, thank you, Foluke. So I think the tax consultant has, Mr. James Winnie had spoken to that is based, there are some profits, I think, below 10 million that is exempt from the tax, and it's also graduated based on that. So yes, if the question means that, yeah, not all profits are taxed, it depends on the threshold. So if the profit is below 10 million, it will not be subject to tax.
Thank you very much, Mrs. Gloria, for that response. Okay, so I have another question here that says, those shares bought before the effective date of current CGT, those shares bought before, okay, sorry, those shares bought before the effective date of current CGT, if sold thereafter, qualify for CGT. Mr. James, if you can help us with that response, please.
Okay, so I want to believe that if you buy any shares from now, right, and thereafter you sell, like I mentioned that, I repeat that CGT is always triggered at the point of you trying to disposing shares, right? And that is why if you make a gain, because you can dispose of shares and not make a gain. But for instance, if you make a gain, then that means that it's going to be subjected to tax. So even if you buy shares now, right, you need to, next year, it will definitely be subjected to capital gains tax. But there's something I mentioned earlier about the cost base, which has to do with 31st December 2025. The market value of that, shares of that 31st December 20 will be determined, right? And if you sell the shares in subsequent periods, maybe in 1st of January, you now sell the shares, right? The cost of that shares will be compared with the amount of the sales proceeds. So when you compare that, is the amount of gain that will now be subjected to tax instead of what you bought now, right? I hope I'm able to clarify that for better understanding. Thank you. Yeah.
Thank you very much. Thank you so much for doing justice to that question. Okay, we have another question here that says that is the capital gain tax applicable to sale of each individual instrument or to an investor's entire portfolio? Ms. Gloria Fadipe, please, could you help us with that question, please?
Thank you, Foluke. I wanted to clarify what the question is. A portfolio has different assets you have in the portfolio. As long as you sell an asset in that portfolio and you have gains that meet the threshold, they will be taxed.
Yeah, I get the client is the participant is referring to like individual stocks. I want to believe, except if the
Yes, if
participants
you
can
have,
throw more light.
take for example, if you have a portfolio with shares in Zenith, shares in this, if you dispose of a particular shares that it's within the threshold and your gains are within the threshold, and the capital disposal is within the threshold, you'll be taxed.
All right, thank you very much. Thank you. Okay. Okay, so there's a question here that says, is CGT applied to share transfer to children via share transferred requests? Is CGT applied to share transfer? I believe the participant is asking with regards to maybe he's transferring shares to his children, if CGT would apply to that. Sorry, Mr. James, please, could you help us throw more light into this?
Okay. In the law, there was no mention of either children or adults. Okay. So if you transfer, what the law specifically mentioned actually has to do with approved, if you transfer of shares amongst approved lender and approved borrower. And like I mentioned in my earlier discussion, I said that an approved borrower is somebody that is being granted license by SEC, okay, to operate as a trader, right? And so either you transfer your shares to your children or anyone, it will still be subjected to capital gains tax, because the individual will definitely be treated as an entity. And for the earlier question, which you asked earlier, just to also add, in addition to what Madam mentioned, it says the aggregates. Madam mentioned the aggregates of your investments. So if you have shares scattered everywhere, it means that you as an investor, you need to aggregate everything, okay, and subject it to CGT, because when the tax authority is liaising with you as an individual, they are liaising with you only as an investor, and they are not liaising with any other person. So you need to put because all your income needs to be subjected to tax. So you need to aggregate everything together. If it falls beyond the threshold, then it's going to be subjected to tax. Yeah, just in addition to what Madam had mentioned. Thank you.
Thank you very much. Thank you very much, Mr. James, for that clarity, for providing more clarity to that question. So I think the last question I have here says, okay, so the last question says, what's the CGT for someone living outside Nigeria when they sell shares? So I guess this is to answer the questions as to what applies to non-resident diasporans when they sell their shares. Sorry, Mr. James, please, we want you to answer that.
Okay, so if a non-resident sells shares, right? I guess that's the question. Okay,
yes,
so
please.
Okay, so if a non-resident should sell his shares, ordinarily is supposed to be taxed. There's nothing that has to do with Nigeria, right? Because you are non-resident. If you are not resident in Nigeria, you are not expected to even pay taxes in Nigeria, unless for some certain conditions. So there are some certain conditions that will make you to be a non-resident individual and at the same time pay taxes in Nigeria. For instance, is the 183 days. If you have spent over 183 days in Nigeria, okay, either in the times of holiday or whatever, the aggregate is more than 183 days, you have to pay taxes in Nigeria, right? But for shares, I think shares is also peculiar in the sense that if it's a corporate investor, for instance, and a corporate investor is holding shares in Nigeria, for instance, it is more than 50%, right? If you are, that means that it's more or less like you're an holding company. When you have more than 50% shares being held in Nigeria, I mean, a company, Nigerian company, then that means it's more than 50%. Then if that foreign entity now disposes of the shares over there, right, it means that it's going to affect the Nigerian entity. So what the law, that is indirect way of, they call it indirect transfer in accordance with the act. It causes indirect transfer of shares. That means that shares that you dispose outside the country will also be subjected here in Nigeria, okay? Unless if the gain is now probably brought through an approved government channel, okay, which is like the Central Bank of Nigeria and the likes, then that will now probably be considered as exempted. So those are the nitty-gritties behind non-resident entities. So non-resident company do not necessarily have to pay tax CGT, but there are some certain conditions which will make them to pay CGT in Nigeria if they fall under that category. Thank you.
Thank you very much. Thank you very much, Mr. James, and to every member of the panel session. Indeed, it has been an insightful and enlightening session. Apologies for, we're trying to keep up with time. I see some questions just came in. Unfortunately, we might not be able to take them because we're trying to make sure that we keep to time. So for the questions that we're unable to take at the moment, we would appreciate if you can send them to us. You can reach out to us via email. Our email address is cslservice@fcmb.com or cslcsu@fcmb.com, and we'll be glad to answer your questions. The recording of this webinar will be shared to every participant of the webinar. It will be shared via email. We'll hope that this session has been enlightening. It has answered the many questions that we all had before joining this webinar, and we hope that with the clarity and the insights that we have gained from this webinar, we'll be able to plan our investments going into the new year, and also has helped us to have better understanding when it comes to the capital gains tax that is going to be commencing from January 2026. Would like to sincerely appreciate each and every one of us here today for taking time out of your very busy schedule to attend this webinar, and we wish you a very fruitful day ahead. Thank you very much.